Good day, everyone. For this assignment, we focus on Pos Malaysia and GDEX, which is two well-known courier service companies in Malaysia. They are registered under Bursa Malaysia. These companies play an important role in supporting the country's logistic and delivery network. Through this comparison, we aim to understand how both companies remain competitive in the logistic industry and identify the key factors influencing their financial performance, strategic decision, and long-term sustainability.
Hi, Assalamualaikum. My name is Ayuni, and I will be talking about our first key findings in this analysis. Which company has the highest liquidity? To understand which company has the highest liquidity, we need to use current ratio and ratio in combined analysis of these two companies, which is first is GDEX Berhad, second is Pos Malaysia. Why do we need to use the ratio? This is because current ratio and quick ratio show the firm's ability to settle short-term obligations. From 2022 to 2024, GDEX Berhad show a very strong liquidation position. Its current ratio and quick ratio remain well above 1. It shows that GDEX has more than enough current asset to cover its short-term liabilities, even without relying on its inventory. In contrast, Pos Malaysia record both of the ratio below 1 throughout the period. This shows
Next,
that the
for
current
my
assets
turn,
are
I will
insufficient to
explain
cover
about
its
return
short-term
on
liabilities,
equity, also known
indicating
as
weak
ROE.
liquidity and potential
Return on
difficulty in
equity is
meeting
a key
short-term
financial
obligations.
metric that
Overall,
shows how
GDEX
much
Berhad
profit a
show more
company makes
liquidity
using
than Pos
shareholders' money.
Malaysia.
In simple words, ROE tells us how efficiently a company used the money invested by its shareholder to generate profit. The formula for ROE is net income divided common equity times 100. If the ROE is high, it means the company is good at generating profit from shareholders' investment. If the ROE is low, it shows that the company is less efficient in using shareholders' funds. Therefore, ROE is very important because it helps investors evaluate a company's performance and profit. Now, I will explain about key finding of ROE for company GDEX Berhad. So, for 2022, GDEX Berhad gets negative 3.52%, increase to 2023 negative 9.85%, and increase to 2024 negative 0.51%. Now, ROE for Pos Malaysia for 2022, Pos Malaysia get negative 25.94%, and 2023, Pos Malaysia get negative 32.03%, and the last one for the 2024, Pos Malaysia get negative 69%. GDEX Berhad records negative ROE throughout the period but shows improvement in 2024, indicating reduced loss for shareholder. In contrast, Pos Malaysia reports extremely high ROE percentage due to negative equity, which signals financial distress rather than strong performance. So, you all can guess who the winner is? GDEX Berhad.
Today, I will explain the debt to equity ratio for two companies, which are GDEX and Pos Malaysia, from the year 2022 to 2024. Debt to equity ratio measures how much a company relies on debt compared to shareholders' equity to finance its operation. A lower ratio generally indicates lower financial risk. From 2022 to 2024, GDEX maintained a conservative and stable debt to equity ratio, ranging between 23.24% and 24.53%. This shows that GDEX relies mainly on its own equity rather than debt to fund its business activities. Such a low and stable ratio reflects strong financial discipline, lower interest burden, and reduced financial risk. Overall, GDEX capital structure indicates that the company is financial, stable, and well managed. Pos Malaysia, in contrast, Pos Malaysia recorded a very high and increasing debt to equity ratio, rising from 127% in 2022 to 192% in 2024. This means that Pos Malaysia used significantly more debt than equity to finance its operation. A high ratio like this suggests high financial leverage, which increases financial risks and interest obligations. If not managed properly, this could negatively affect the company's long-term financial sustainability. In conclusion, GDEX is financial more conservative and stable as it depends mainly on equity financing. Meanwhile, Pos Malaysia faces higher financial risk due to its heavy reliance on debt. This comparison clearly shows that GDEX has a stronger and safer financial position compared to Pos.
In conclusion, we look at the financial performance of GDEX Berhad and Pos Malaysia using liquidity, ROE, and debt analysis. First, GDEX has a good liquidity because its current and quote ratio are high. Pos Malaysia has a low liquidity. Second, both companies have a negative ROE, but GDEX improved in 2024, while Pos Malaysia is dropped. This shows GDEX managed shareholder capital better. Third, GDEX has a lower debt and debt to equity ratio, so it has a less financial risk than Pos Malaysia. Among the three analyses, ROE is the most important because it shows how well a company makes profit from shareholder capital. Overall, GDEX is strong, safe, and more stable than Pos Malaysia.